Thank you so much, and good morning to everyone. So my name is Izzat Begum Rajan. As you may know or not know, I am French, born and raised in Paris, but I'm actually a daughter and a granddaughter of African nationals, so Africa is definitely in the house. I'm also of Iranian and Indian descent, hence the weird mix here. And I'm an international tax attorney. I have several activities. Number one is that I'm an entrepreneur. So I have my advisory firm, Imani Partners, but I also run a tech venture that I'm currently building called Low Tax for Blockchain.io. It's still a placeholder, but the idea is that we would put on-chain the latest laws, hopefully from a lot of jurisdictions, automated with having prompts through a, let's call it AI, not to be too contentious this morning, but that an AI would pull from the internet and then integrate, inscribe onto the chain, and then a human being would verify whether that's the latest state of the art or not. The idea is that instead of me spending 3 to 4 hours having a first or second conversation with a potential client, then they could have that conversation with an avatar that would be a chatbot talking like me, looking like me, or funkier than I am, and then being able to sort out the issues so that then I come in as a human being and then have the valuable conversation. My second activity is that I have board mandates. So these are some of the examples, and the latest is that I have joined the board of INADBA. I was elected in April, I believe. I'm the co-chair of the finance working group within INADBA. So it's a group of 250 professionals, and we put together replies to regulators globally. My third activity is pure advisory. Some of the names of my clients I cannot disclose because we're recorded and it's gonna go online. Some of them are on the board, and I have become an advisor to the President of the French Republic and of the Prime Minister Cabinet, and also the EU Commission in the last few months. Thank you. And my last activity is that I'm a PhD researcher in my third year, writing on taxation of digital assets. So I teach in all those places, and of course now HTW. I'm an international tax attorney by education and practice. I've been around for 25 years. EMEA, with an I in it, is my playfield. I'm an ex-Maersk, for those who know the Danish consortium in the shipping industry. I was head of tax for half of the world there for some years. I'm an ex-EY equity partner as well, a decade ago. I was their first woman in Africa and also the youngest partner. And now we get into the meat of the topic this morning, taxation of digital assets. So we'll start with some introductory remarks, not too heavy. I'll also try to give you some idea of what the taxonomy of the digital assets would look like, some of the issues that we encounter with the current state of law, with the emerging standards that we have globally, but also I'll get into corporate tax, capital gains tax. I'll talk about withholding tax, transfer pricing, but also VAT, potentially custom duties, and then we'll look at some very specific taxable events to the crypto industry, and then what the future would look like. So, as a tax lawyer, our thinking process is in 3 steps. One, we look at legal qualification of what we have, the transaction we're looking at. Then we move on to accounting. Which class of revenue is that? What is the wealth created? Where does it fit into the accounting standards? And then we draw the tax consequences. So you may think, oh, but you barely have a regulatory framework today. Why does it matter to you? Simply because my conversation cannot happen in 10 years. It has to happen today because the regulatory framework conditions the legal qualification of what we're looking at. So I may be 5, 10 years ahead, and yet I'm involved at the heart of the discussions with regulators because it matters, because it conditions my work in a decade from now. What assets are we talking about? So, bear with me, the taxonomy is not complex, but it is actually crystal clear. For me, there are 3 categories of digital assets. One, the payment tokens, the ones that are used to pay for goods and services, whether in real life or whether delivered virtually in a metaverse, for instance. The second category is the security tokens. There, what makes the difference with the utility tokens is that you have the expectation of deriving a revenue when you are the holder of that token. The third category is, of course, the utility token. There, it's purpose-driven, and there's an impact above and beyond the P&L value of the project. And that triggers some discussions about the valuation of those assets. So I gave you some examples. Payment tokens, it's Bitcoin-alike, stablecoin, what Mika has renamed e-money tokens, so EMTs. The CBDCs, central bank digital currency, that's also considered as a payment token. And then you have probably others, as long as you are pegged to a currency that is considered as fiat, so the ones that are euro, GBP, USD, you name it, these would be considered as payment tokens. Security tokens, they are, so the ones we expect to derive revenue from, and most equity tokens are considered as security tokens. But, and I'm getting to the but, like Katarina said yesterday, I'm a lawyer, except that as tax lawyers, we even go as far as to say, it depends. If your equity token is about tokenizing the shares of a commercial company, there's no doubt, right? It's a security token. But if tomorrow your equity token is the tokenization of shares of a transparent company for tax purposes, does that make it a security? I don't know, I don't have the answer, but I would say it depends. So it depends on the view of the tax authority on that entity. Then the utility, so purpose and impact. The most common utility token we know is governance token. And you're gonna ask, so where do we put the real world asset tokens? And I would say it depends, because it depends on whether there is an expectation of deriving a revenue or not. It depends on whether those real assets, real world assets, are considered as treated as security, taxed as security in the real world. Potentially that would be influencing the taxation of the digital representation of that real world asset. And then on the regulation side, you know that payment tokens, some of them are regulated because of MiCA now. Security tokens are always regulated, and then utility tokens are considered as unregulated. But again, there is a discussion as to some tokens are utility or security and whether they are regulated or not regulated. Then what activities can be taxed? So of course the issuance, of course the exchange, of course the mining, but then what about the rewards? And we'll get to that a bit later, because that's a term that I will define then. What taxpayers? So you have the individuals, natural persons, here us present in this room, or you have registered entities. And I use that term on purpose because they can be either corporates or they can be foundations. And usually there are foundations, there are associations in the very famous canton of Zug in the middle of Switzerland. And therefore, they have a differentiated taxation regime. What about DAOs? So for DAOs, it depends on the legal wrapper. What we call a legal wrapper is the legal shape, and the legal form that you will use and where you would anchor it in the real world. You can be a group of individuals in the Pacific Islands and then decide that you want to register yourself somewhere in Germany. You may use a legal wrapper that looks like a not-for-profit, and therefore you would attract taxation of that not-for-profit form in Germany. Is that simple? No, because we have a construct in international taxation that is called permanent establishment. That is an individual, a human being, sitting in Germany, yet operating, for instance, an entity, acting on behalf of an entity registered in Spain, but that person is actually producing revenue, generating profit for a company in Germany, and therefore the profit, the portion of the profit of that Spanish entity, but due to the activities of that human being in Germany, could be taxed in Germany. And that's a permanent establishment construct in taxation. So the state of the law and principles. Of course, we have a multi-layer framework, domestic, regionals. We know that by heart in the EU. They are evolving and they are fragmented. The principles of taxation. So we have special cards in taxation. The corporate law and the contract law can say whatever they want. The regulatory framework can say whatever it wants. In taxation, we can do autonomy of the definition for tax purposes. It's a challenge, but it's also an opportunity, because today, for instance, in France, one of the discussions that I had with the cabinet of the Prime Minister is to say, guys, you can't make a circle fit in a square. You can't apply the 70-year-old framework that exists for financial sector and services to the blockchain activities and the speculative activities in the blockchain industry. Why don't we draft a new law, a good, big, fat, juicy law, specifically for digital assets in France, and write all the definitions that we would like to have for clarity purposes, for tax and accounting purposes? Oh yeah, that's a brilliant idea. So the guy at the cabinet of the Prime Minister says, yay. And the cabinet of the Ministry of Finance says, nay. So we ended up with a budget law for 2024 having just 3 lines on mining taxation, mining activities taxation, and that's it. Oh, sorry, one more thing. We also have in taxation something called neutrality of technology. When we went from paper-based books to e-books, how do we tax that? Do we tax that as an electronic service, or do we say an electronic book is the same as a paper book, and therefore the VAT and the taxation of the activities around an e-book production, editing, selling is the same as for a paper book? So we went for that solution, saying, no, an e-book is the same as a paper book. Therefore, the technology is neutral and doesn't affect the nature of the good and doesn't affect, therefore, the taxation. Can we use that as an immunity card in the blockchain space? It's actually to our disadvantage, so we won't do that. Because if we were to use the technology neutrality, in some instances, when we look especially at the financial instruments, the crypto financial instruments, then we get into crypto taxation. When it comes to e-money tokens, the stable coins, we could consider them as currencies, the bitcoins, etc. Then it would be to our advantage. And we can say, no, technology doesn't matter. It's not because it's an electronic money that it doesn't have the same status as a currency. And the courts are still scratching their heads to find the best way to balance sovereignty of the states, because money is, of course, a sovereign matter, to balance that with the advantage of collecting revenue from the industry, at the same time trying to strike the highest level of compliance for the players in the industry, and at the same time giving legal certainty and readability of the rules. So it's a lot of criteria to balance, and it feels sometimes that we are on one hand like this and trying to juggle with too many balls up in the air. The challenges. So the directive called DAC 8 is actually transaction-based, reporting. It's a translation of something called Crypto Asset Reporting Framework, which is, and I will come to that, a standard issued by the OECD. Except that DAC 8 takes lending and staking into account, without defining it like we do in the industry, by giving some very blank definitions that are actually not fitting what we do and the nuances in particular that we practice in the industry. Because there are several staking. There's staking pools, but there's staking as a service, there's DeFi staking, and I can go on. There's quite some nuances where you have custody, where you don't have custody, where you are getting interest, where you are getting rewards that are still not sure on the legal qualification. And then you have the transfer of fund rule, which is also another directive actually adopted at the same time as MiCA in Europe. And that says that every time you have a recipient or a sender that is registered for tax purposes in the EU, you have to disclose those transactions, crypto, to the tax authorities. And there's no minimum amount. So does that mean that when I have 0.1 euro of crypto transaction gain, I have to disclose it? I don't as an individual, but the platform operating my wallet will. So if you don't declare it as an individual in your tax return, you won't get caught yourself. Now, when the exchange will report that transaction, because it has to, then they will be able to pull the thread and come all the way down to you. So careful with your tax returns and your disclosures. So the OECD, the CARF already talked about that. Now, some urban legends. On direct taxation, we all had those who are advising clients and individuals. We know that, oh, I don't convert to fiat, therefore I'm not taxed, but I don't have to disclose either. Wrong. The next one is staking rewards are not taxed. Wrong. My crypto tax software does it for me. Well, actually, it gives you an indication of what you have to report, but you still have to disclose and report. And then potentially you're going to be taxed. Airdrops are not taxed. Wrong. They are rewards. They are monetary rewards. Therefore, you have to report them, you have to disclose them, and therefore you will be taxed on them. And I cannot be identified and I won't be taxed. Game over. Wrong again. And that is not applicable to crypto. Super mega wrong. So now that we know that we're taxed on every single transaction and that both corporates having those activities called crypto asset service providers and individuals, crypto holders, have to report, disclose, and then be taxed. How does that work? Because we all know that the rules are not set yet. So what are the taxable events? I'm an individual, I buy, I need to disclose, I need to report, I may be taxed. I may be taxed short-term, I may be taxed long-term, and we're going to come to that. I receive, so the airdrops, or when we experience a fork, like Bitcoin and Bitcoin Cash, what happens? We need to look at the reason. We need to look at the why and the how. Is it me as an individual digital asset holder that then gets a reward because I'm holding, because I'm contributing actively to a town hall? What is the reason and how do I get rewarded? I send crypto assets. So either I pay for a service, I pay for a good, I convert one digital asset into another. For instance, with my USDC or my USDT, I buy a Bitcoin. Or I sell. So the fact that I convert a stable coin to a, let's say, utility token in a ecosystem means that I'm selling my digital assets, my stable coin, but I am buying also something else. Does that mean I'm taxed twice? It could be. So there's a difference between corporate tax and personal tax. I won't get into that. We have understood at this point in the presentation that you have to report, you have to disclose, and because there is a purpose to be taxed and to be compliant. Capital gains tax. Capital gains tax can work differently if you are a holder of an asset within a year, beyond a year. That's what we call short-term capital gains tax or long-term capital gains tax. And it depends on the jurisdiction, it depends on where you are a tax resident. Withholding tax. So I structured a deal where a company incorporated, I would say, not to disclose the country, but in a place where you have lots of coconuts, turquoise sea, and white sand beaches, many places on planet Earth. That company there wanted to fund a real estate developer in Southern Hemisphere country to build affordable housing for the middle class. Instead of doing a financial instrument that would look like a loan extended by a foreign company to a local tax resident, I structured it as a double sale of assets. Double sale of assets is something that it's a transaction that is the most vanilla, a sale of something. What we did is that I looked into the constructions that exist in Islamic finance to go around the prohibition of the interest, riba. And there, the borrower sells the house for mortgage to the bank and buys it back over time for a higher price equivalent to what would have been the interest rate on a loan. It's not a loan, it's a double sale of a house to finance the mortgage, the purchase of that house. So I did the same, and by analogy, I applied the double sale of digital assets. The borrower issued minted NFTs, sold them X to the borrower, to the lender, who's my client, and bought them back from the lender at a higher price over time. It's a decade with schedules of payment quarterly, and the supplement amount was the equivalent of what would have been the interest rate in the case, in the matter. What we did is that we used stable coins, because stable coins allows you not only to beat inflation, but also to manage your Forex risk. Because it was in an exotic jurisdiction where the borrower was with constringent foreign exchange laws, where we had to go and kiss the ring of the central bank as if it were the godfather. Luckily for me, using stable coins and a double sale of digital assets, we managed to bypass that and to be able to fix the interest rate, to fix the payment schedule, and not to lose value on the money over time. And it was signed off by the commercial bank of the borrower and the tax advisors of the borrower. And so on that, we had to apply withholding tax, because paying an amount to a company abroad would mean that you pay withholding tax. So we made it look like it wasn't a gross up of the withholding tax, but that the payment would take into account the withholding tax that the borrower in that country in the Southern Hemisphere would have to pay to the tax authorities, but in fiat. So they would get their financing in digital asset, convert to fiat, and then pay the withholding tax locally. Transfer pricing, I'll get to that a bit later. And so individuals, registered entities, domestic, international, we've covered that. So how would we tax actually and calculate the taxable income? Well, it depends on the legal category of the taxpayer. We've covered that. And on capital gains tax, when we look at the example of France, it refers to the regularity of how you trade, to make the difference between an individual and then a professional activity, except that regularity is not defined for crypto asset investment and trading. So does it mean that we have to use a reasoning by analogy and look at the regularity and professional investment in the traditional fiat financial sector? We actually don't have the answer to that question. But the delta between the tax rate if you are an individual or if you are a professional is 15%. On a trade of 100 euros doesn't really matter, but on a trade of 1 million euros or a gain of 1 million euros, it does matter. And the same international, so withholding tax, the existence, you also have to look at whether you do have a reduction of your withholding tax if there is a double tax treaty between two jurisdictions. And that's an issue because we still don't know what article in the double tax treaty we need to use. Indirect taxation. The main issue there is the fact that we use pseudos or we use an identification number that is our wallet, and that we can also hide where we are located with turning on VPN or using Tor. VAT, the principle is that you tax the final consumer. But if you cannot identify for sure that final consumer and therefore determine as well where the final consumer is located, how do you apply the right VAT rate and how do you even work that out? And again, for the real world asset tokens, there could be custom duties. But what if your asset doesn't travel? A house, last time I checked, doesn't travel. Yet the digital representation of that, a tokenized real estate, would travel technically. How do you apply custom duties? So the specific taxable events are those, column left, and we also have deductibles for tax purposes. That would be the right column. Transaction fees, gas fees, sometimes Forex fees as well, when they are charged by the platforms. Do we have guidelines as to how to tax those events? No. Do we have the beginning of answers, whether in civil law or in case law, in the common law jurisdictions, to be able to tax those? Sometimes, but we don't have answers for sure, so we're still searching. And now, what is ahead? So we have a lot of uncertainties, as you have heard. There are some internal uncertainties very much specific to the crypto industry, because when we talked yesterday about FTX, do we have a set of rules for crypto companies in trouble? How do we refund the investors who were spoiled? We don't know. And you have the external factors. The external factors being extraterritorialities. The SEC can look at any transaction in the world in USD. Europe can look at any transaction as long as one of the parties is registered for tax purposes in the EU. And you have many other similar rules elsewhere in the world. Will the standard emerge or has emerged? The answer is yes. The CARF by the OECD has been announced by the OECD as a global standard, and they will make sure that all the countries in the world sign up for those and integrate that in their domestic laws. You also have discussions at the International Accounting Standards Board. Back in September 2022, there has been a first paper, and it's a project about taxation of digital assets as if they were intangible assets, but not financial instruments. It's a beginning of an answer. And the only organization that I could find in the world is Unidroit, that has actually looked at the technology and tried to define that, and from there draw some legal qualification and some taxation rules. Thank you very much for your attention. Sorry I was a bit long.